Money is a hallucination. It is a shared dream that only works as long as we all agree not to wake up. In a quiet room in Washington, D.C., a handful of unelected officials sat around the mahogany table and decided to change reality. They didn't build factories, they didn't mine gold, they didn't invent new technology. They just clicked the button. And just like that, $3 trillion appeared out of thin air. That is more money created in a few months than the United States printed in its first 2 centuries of existence. You felt the shockwave of that click when you tried to buy a house. You felt it at the grocery store. You felt it in your savings account, which suddenly bought less than it did the year before. We like to think we work for money, but the truth is much more uncomfortable. We work for the people who print the money. Welcome to the machine. Most people think of the economy like the weather. Sometimes it rains, sometimes it's sunny, and there's nothing you can do about it. That is a lie. The economy isn't nature, it is an engineered system. And right now, the engineers are sweating. We are living through a historical anomaly. For the last 40 years, the world has operated on easy mode, cheap debt, low inflation, and endless growth. But the gears are grinding to a halt. You are seeing headlines about interest rates, banking collapses, and debt ceilings, not because the news cycle is bored, but because the engine is overheating. To understand why your rent is up 20% or why your grocery bill feels like a car payment, you have to look at the invisible entity pulling the levers, the central bank. In the US, it's the Federal Reserve. In Europe, the ECB. In the UK, the Bank of England. Different names, same superpower, the legal monopoly on counterfeiting. Let's look at how the magic trick actually works. Forget the complex academic jargon. Forget open market operations or yield curve control. Think of the economy like a car. The central bank is the driver, and they only have 2 pedals. The first pedal is interest rates. This is the brake. When the economy is moving too fast, when everyone is buying things and prices are skyrocketing, the central bank stomps on the brake. They raise interest rates. Suddenly, borrowing money becomes expensive. Your mortgage rate doubles. Business loans get costly. People stop spending. Companies stop hiring. The car slows down. The second pedal is liquidity. This is the gas. When the economy crashes, like in 2008 or 2020, the driver panics and slams on the gas. They lower rates to 0, and crucially, they start quantitative easing. This is the polite term for printing money. They buy bonds from banks, flooding the system with fresh cash. Suddenly, banks have money to lend, stocks go up, and everyone feels rich again. It sounds like a perfect system, a thermostat for the economy. Too hot? Cool it down. Too cold? Heat it up. But there is a massive problem. The driver is blind. See, the data the central bank uses, unemployment numbers, inflation reports, is lagging. It's history. By the time they see the data, the event has already happened. Imagine driving a car at 100 miles per hour, but your windshield is painted black, and you're driving solely by looking in the rearview mirror. That is the global economy. They press the gas. Nothing happens immediately, so they press it harder. Suddenly, the car rockets forward, dangerously fast. Panic. They slam the brakes. The car skids. This isn't hypothetical. This is exactly what has happened to your money over the last 4 years. They printed too much, caused inflation, and now are slamming the brakes, risking a crash. Now, here is the part that should make you angry. When the central bank prints money, they don't drop it from a helicopter into your backyard. If they did, prices would go up, but at least everyone would have more cash. No, the money enters the system at the top. It goes to the big banks and financial institutions first. This creates a phenomenon known as the Cantillon Effect, named after an 18th century French banker who realized the game was rigged. Here is a timeline of a printed dollar. First, the insiders. The central bank creates money and gives it to commercial banks. These banks use it to speculate or lend to massive corporations. They get the money before prices have risen. They get maximum purchasing power. Second, the asset class. The money flows into the stock market and real estate. If you own assets, stocks, a house, gold, skills, you get richer. This is why the stock market can hit all-time highs while the actual economy is in the toilet. Third, the working class. Finally, years later, that money trickles down to your wages. But by the time it reaches you, the prices of bread, gas, and rent have already gone up to match the new money supply. You get the inflation, they get the asset appreciation. The mechanism of central banking acts as a wealth transfer pump. It sucks value from the savers and wage earners and sprays it onto the asset holders and debtors. If you keep your money in a savings account earning 0.5% while inflation is 5%, you aren't saving, you are bleeding. You are paying a hidden tax to the people who printed the money that diluted yours. But wait, aren't these people experts? We see them on TV in nice suits using words like transitory and soft landing. The irony is that central banks rely entirely on confidence. Money is fiat. Fiat is Latin for let it be done. It has value only because the government says it does and because we believe them. If we stop believing them, the paper becomes worthless. So the central bank's primary job isn't economics, it's psychology. They are professional hypnotists. In 2008, the Federal Reserve said the subprime crisis was contained. It wasn't. In 2021, they said inflation was transitory. It wasn't. They cannot tell you the truth. Imagine if the chairman of the Federal Reserve walked out to the podium and said, "Honestly, we printed way too much money. We don't know how to stop it without crashing the stock market, and your savings are going to lose 15% of their value." The system would collapse by lunch. So they speak in Fed speak, a language designed to be boring and vague, keeping you calm while they desperately try to fix the plumbing behind the walls. Here is the cliffhanger we're standing on right now. The world is drowning in debt. Governments, corporations, and households owe more money than has ever existed. This puts the central bank in an impossible trap. If they keep interest rates high to fight inflation, the debt becomes too expensive to service. The government can't pay the interest on its own bonds. Banks start to break. The economy collapses. But if they lower interest rates to save the economy, inflation roars back, destroying the currency. They are trapped between a depression and hyperinflation. The likely outcome is that they will choose the path of least resistance. They will eventually print more money. They will choose to sacrifice the value of the currency to save the system from defaulting. History shows that every fiat currency eventually returns to its intrinsic value, zero. The Roman denarius, the French assignat, the Weimar mark. The dollar, the euro, and the yen are on the same timeline. We are just moving slower. So what do you do with this information? First, understand that money and wealth are not the same thing. Money is just the tool the central bank controls. Wealth is real assets, businesses, land, gold, skills. The game is designed to strip you of your wealth by devaluing your money. The next time you hear a central banker speak, ignore the words. Watch the hands. Watch the liquidity. Watch the balance sheet. Because while they're telling you everything is under control, they are quietly clicking that button, diluting your labor $1 at a time. The system isn't broken. It's working exactly as it was designed. The question is, are you positioned to survive their next click?